week will be, right? All the news and everything that's going on. Which is kind of timely because a lot of people are saying, because of this event or because of this election, should I get in or out? And should I do things on a short term? We don't deal on short-term basis because you can't control it. The short-term value of a stock is what somebody else will pay based on their opinion. But the long-term value of the stock is how well they perform, and they're performing now, increasing their earnings and things like that. Or you could gamble on a stock and say, I think this is going to go through the roof if it doesn't have predictable earnings right now. And 1 out of 10, you might be right. But it's a good idea to allocate everything appropriately. So far, and this is a very brief class, but we touched a little bit about the phases of the investment process. And I say investment to keep your attention because it's really a financial planning process. We do it in threes. The first phase, we talk a little bit about the financial planning diagnostics. Look into your cash flow, your insurances, what do you need or what you don't need. Look into your taxes, should you do this or not. There's a variety of things to look at there. Look at your estate planning documents. It's all in the book, so you could do this yourself and see if you have these things. You could actually do some online if it's pretty simple. And then you get to the investments, and we're learning a little bit more about those because we have a shorter class and we want to keep us motivated, right? But then after the first phase of the financial planning diagnostics, getting everything in order, the second page is, I've looked at the investments in these other things. I know what an exchange traded fund is, or an index fund, or a mutual fund. I have some idea. We'll talk about it again today. But now the second phase is I'm going to reconstruct or construct my portfolio or portfolios, right? Could be one, it could be several. But I want to have some idea of what to look at for those, so I don't realize that I've been in this fund or this portfolio for 20 years, and I'm paying 0.5%, 1% more in expense ratio, when maybe I could have done something a lot cheaper with Vanguard, Fidelity, or Schwab, and so on. So we'll look at the construction of the portfolio. We'll go through it a little bit quick, but you can always go to the website. The classes that Nash teaches, he goes into greater detail. You can always look through 12 courses. We're up to, what, 6 or 7 recorded?
7.
7. So if you want to get into that more deeply, or it's also outlined in the book. So financial planning done, portfolio construction, and then the last part is we'll give you some tips on how to maintain the monitoring of the financial planning, but most importantly, more fun, is the investments. But what's the point of investing if you lose it all because you were underinsured, you left it to somebody, or some problem occurred? So do handle that, but we're going to look a little bit more at the portfolio, a little bit more fun. But do remember that obviously investing is more about the long-term objectives and appropriate investments and allocations. And if the market tanks in the short term, we've already planned that out. But if that happens, we have money for short term, right? We've got cash, CDs, money markets, ultra short-term bonds, things that you can get your hands on with very little or no bruising at any time. But in the long term, they're not going to earn as much. Right now, short-term yields are pretty high. And it shouldn't be that way. They should be low, and long-term yields, long-term commitments should be higher. That helps the economy more. But right now there's uncertainty, so people are in the short term. And the uncertainty is primarily the government spending. Will we ever get that under control? We'll see. But short term, and then we talk a little bit about intermediate term, meaning not that you're stuck there for any period of time, but if you buy, I don't know, a 1-year treasury bill and you sell it in 6 months, you might get more or less than you paid for it because it's sold to the market until it matures. Then you get your money. If you buy a 30-year government bond and interest rates go up, you can't sell it. If interest rates go down, everybody's your friend. They want to buy it because you're getting a higher rate than the new rate. So intermediate term investments is just in your mind. It's an intermediate term commitment and horizon. If I buy a balanced mutual fund in my intermediate term basket, it's paying 2% yield. If I stay there at least 3 years, maybe 5 or 6, then I'm going to get at least 5 or 6% in dividends that if I get a flat tire, it'll pump it back up a little bit with the yield. So short term, no volatility. Intermediate term, some bruising, but enough time will give you a recovery with dividends, hopefully. Long-term investments might be 7 years and beyond. And those are investments that you allow them to go up and down in value. However, if we're fully retired and not buying into a declining market, it's a good idea to have long-term investments, at least have 1, 2, 3% dividends, because then you get that consolation prize that when the market tanks, you're buying more shares. But dividend-paying stocks, or funds in our case, are not a guarantee. You're giving up upside growth for current income. It's like buying a rental apartment building, if you could afford it, or a rental that's in okay shape, but it's getting the maximum rent you'll ever get. So the price is pumped up because they've done all the work. Versus a piece of land that nothing's happening, but you hope someday that's going to be next to a Walmart or something. So everything's relative, and everything in the public market is priced to what it's worth, and what it's worth is what somebody else will pay. Now, you could buy a stock fund that pays 5% dividend, and the price is too high or too low, but you want that dividend. So you decide if it's a good price or not. So with that said, let's go in. And it was exciting that we didn't even get to our slides last week. That was fun. But I'm going to get back on track to some of these slides here. And the first thing that we want to mention, when you get to the point where you're going to complete and construct a full portfolio, diversity has always been most important for us. At this point, we want to diversify, and we want a portfolio with thousands of stocks and bonds in it. Okay, so if one goes bankrupt, you don't have to panic. It happens. You don't have all your eggs in one basket. Then we want various types of funds, so one isn't the same as the other, right? Gold now is being talked about because, wow, it's not down, it's up a lot. But I bought gold at $975, and you would think that's a good price, but I bought it in 1979. So it hasn't done much, right? Now, if I just bought it for a cheap price, wow, I'm smarter than everybody else. But gold is a short-term panic area that people rush to, and so we try to stay away from whatever's super hot. You'll get your best buys buying something where other people aren't excited about it yet, or maybe they talk down about it, or it just crashed. You'll get your best purchases. Nothing wrong with having 3% in your portfolio in gold to try to balance things out when the market falls, but the only gold that I would hold would be numismatics, collectible coins, and have a safe place to store them. Therefore, like in my case, if they don't do anything, you at least have these nice little coins to pass on, and they're pretty cool. History in that. Or if you have any silver coins, don't tell anybody where these things are. Don't tell us that you have them. We don't want you to be robbed. So internal securities, stocks and bonds, CDs and T-bills inside the funds, and various funds that aren't the same as each other. One's up, one's down. They're not correlated and not exactly the same. Cash is not correlated to stocks, right? It's almost like a negative correlation. So if stocks fall, we're really happy that, I got those CDs and maybe some bonds. I'm so smart. But if you look at the long-term track record, cash is lousy because it's more like the oil in the engine. It keeps things going, but it's not producing the power, right? The real power is going to come from the stocks. Cash, bonds, those are great. I have them in my portfolio, but that's my panic money, and that's money maybe for the first few years of retirement. Cash is a lubricant. It keeps things going, keeps the engine moving, but without those long-term stocks, you don't have any growth. Now, why would you have growth in stocks? Because those are the companies that produce the goods and services that we all buy, right? We go to some store, we have to buy those products. We're going to depend on those companies producing the goods and services we're going to purchase. And they can raise the price if they feel they need to, as they are. And they can shrink the package as they are, and they're still making a profit. Now, you can blame the companies, but they're trying to survive. And they need to make a profit, right, for the investors. So short-term cash, intermediate-term bonds, maybe some balance funds in there, whatever the bruising risk is, you take it. And then long-term are stocks, real estate, businesses. And short-term is 0 to 3 years, let's say. Intermediate is 3 to 5 or 7 years. And then long-term would be 7 years and more. And you can have several different portfolios if you want, but at least have various funds. And we talked a little bit about what a fund is. That's a basket of stocks, bonds, or cash. And a fund is just a fund. It can be your Schwab account that you put all these stocks and bonds in it, you want to call it a fund. Or it can be a mutual fund that's sold by Vanguard, Fidelity, Schwab, and all these other companies. Why do they provide them? Because they want the management fee. That's not an evil thing. They want to be paid a management fee. But an index fund that does nothing but just buy one of everything should have the lowest expense ratio. We've got them from 0.10 down to 0.015. That's pretty low, right? So those, you're getting just one of everything. However, if you're a non-indexer and you say, look, I don't want the S&P 500 even if it's a free fund, because I believe that 100 of those stocks are lousy. They may be big, they're in the economy, but I don't think Verizon's going anywhere. Is Verizon the S&P, Nash? I don't know.
I don't know if it's in the S&P.
Whatever, there may be a variety of stocks in not just the Standard & Poor's S&P 500 top weighted percentage value stocks. There's thousands of indexes out there you could prescribe to, thousands. Because if I created the baby boomer index and we got together and figured out what all the baby boomers buy, and we put the top 200 stocks of what baby boomers might purchase, and we created a baby boomer index and we published it and we copyrighted whatever they do, and all of a sudden people say, wow, I love that, I'm going to buy the baby boomer index fund. Oh wait, there is no fund. They have the index published, but nobody does the fund. Well, somebody comes to me saying, hey, we're with Vanguard, we pay you $2,000 a month, can we use this index name? Great, they go set up a baby boomer index fund at Vanguard. And then Fidelity gets jealous because they raised $1 billion. Wait a minute, we want to do the same thing. They'll pay me $2,000 a month. And if everybody loves this index, I get a lot of people subscribing to it. And then if I see that the baby boomers are buying, well, let's say this one company dropped in value, then I send out a notice to these people and I say, you need to change this fraction to this to that to keep up with the averages. So the indexes are just an index. They're great because they just buy and hold and they're cheap, 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 but they're not great if they're not rebalancing the way you want. If the stock market crashes, they keep holding those same positions. Maybe if the stock market goes up too much, there are some S&P 500s that might rebalance into an original allocation that isn't just based on who's the biggest. For example, an S&P 500 equally weighted fund, instead of having Apple be 6% or so, Apple might be 1/500. Everybody has the same percentages. That's a good thing when the tech stocks tank and you're going, look at me, I didn't drop as much. But it doesn't grow as much if the tech stocks take off. So there's always pros and cons. Short-term, intermediate, long-term, and we want a portfolio that has thousands of, probably 2,000 to 3,000 stocks if you have an analysis that told you that, and probably 10,000 different bonds. Bonds are not, there's not an index of bonds or a stock market of bonds. There's traders out there that do them. You can check on the prices, but they're not as easily traded like stocks. So it's nice to have bonds inside of a fund. Securities, various types of funds and exchange-traded funds. The ETFs is an exchange-traded fund. I call it an exchange-traded mutual fund, just so we have in our mind, it's a mutual fund. It's just bought and sold during the day, very quickly. And that could be good or bad, right? And you may have some of those mutual funds listed on Schwab, Fidelity, whoever you have a brokerage account with. Now, all the mutual fund companies are really pushing you to go get a brokerage account. Vanguard has their own brokerage accounts that you can set up there. Why are they doing this? Because they don't want to deal with creating and selling mutual funds. They want to go to the ETF model, which is the same thing, but it's less work for them. It's kind of like when you hear about someday the blockchain, you're going to be able to get on the computer and buy a house instantly. When that day comes, that would be a lot less expense for you to buy the house because you don't have to pay the title company and all this stuff. You're tied into an instant credit check or instant this or that, right? That's not here yet, but it's coming with the banks. So the mutual fund companies like Vanguard, they would prefer to see you buy their ETFs, and they would prefer to then establish it, charge a fee, put it in the open market, and let you buy and sell it through your brokerage account. And they do have a brokerage firm inside Vanguard you can do that with, but it's less administrative work. It's listed in the book. I go through every single little step that it takes for them to do all the work behind the scenes, and it's a lot of work. The good thing about the mutual fund is you're buying it from Vanguard or from Fidelity at the end of the day, so it keeps you out of the daily grind of what's happening in the market. But you have to contact them. It could take you half an hour to get on the phone. You can wire money and do everything online. That's fine. But you'll buy the fund or sell it at the end of the day. And they're moving towards ETF land because it's a lot less work for them. And the ETFs, yes, sir?
When you say that there isn't really a bond market, are we excluding the over-the-counter market?
No, yes.
Okay.
Yeah, so you can buy things on the over-the-counter market. You know more about that than I do. What is that related to bonds?
Well, over-the-counter will basically just be not on your centralized exchanges or on big exchanges. So if you're not going to find most of your individual bonds on the NASDAQ or the New York Stock Exchange, but you might find them in over-the-counter, like small bucket shops. Like if you've ever watched The Wolf of Wall Street, that's where he gets his start before he starts his whole giant scam.
Oh, okay. So it's fair to say there's less liquidity, less buyers buying and selling.
Possibly. It's just that they're not listed on the major exchanges.
Because I noticed in COVID, if you had an individual bond, some people complain I couldn't find a buyer for it because everybody's panicked, right? But if you had a mutual fund or an ETF that had bonds in it, it dropped in value, but at least you could find somebody to buy it.
Right.
So there's the what market?
Over the counter.
Over the counter, okay. But not all bonds are listed there, maybe?
Well, the bonds are listed on the over the counter, but not all are on the exchange.
Okay, so if they're not on the exchange, are they going to sell as freely?
Probably not.
Possibly not. So we would prefer use an exchange-traded mutual fund for liquidity. And that was the last thing about the COVID is everybody said, oh no, these exchange-traded funds are not going to be liquid, nobody's going to buy them. They actually were very liquid. Now the price may have dropped, but at least people could get in and out of them, right? Because it's kind of like if you own a piece of property, let's say a commercial building, that you can't sell it, but if you were a member of a group of properties, you could probably sell your shares to somebody else because they're not worried about your individual property. Then again, you make more on your individual property, and on that point, I would not do one of these limited partnerships. Please stay away from those. Whole other story. So multiple companies. So if we have stocks and bonds inside of, let's say, 10 or 12 different investment funds, preferred exchange-traded mutual funds, simply because they're easy to trade, and they usually try to get lower expenses. They don't try, they have to, because the buyers are saying, I'm not paying those big management fees. So most, but not all, exchange-traded funds might have, with the bigger companies, cheaper expenses. But they're not having to do quite as much work, so it brings down the cost. So exchange-traded mutual fund, and when you're in there, you want this one to go left and that one to go right. You don't want all the same funds. A growth fund acts a little bit differently than a value fund. Value is a little more like blue chip, growth is more like, let's say, technology. But if you have all these opposites, when the market in one area goes up a lot, you're not going to go with it. So give that fantasy up, that if the S&P goes up 25, I'm going up 25. No, you're diversified. So if they go up 25, maybe you get 8 to 12%. But if they drop 25, our goal is to drop half as much. Unless you just say, look, this is for the grandkids or this is for some other objective. Now I'm going to buy the S&P 500 and do exactly the same. But the S&P 500 is a mirror of the top biggest companies, right? And if you want to be a part of that, that's great. I would rather be a second chance investor and wait for it to dip a lot, then get back in. It's kind of like if you like or hate Tesla, if they drop to their lowest level, maybe I'll get back in. I don't expect this huge high, but at least they might recover because they have resources. They're more of a technology company, not just a car company. So I'm not endorsing them, I'm just saying we're all second chance investors because we don't want to gamble losing 100%, I would assume. And we like to be liquid and get in and out of our accounts because we don't want to be told that you can't, right? And that's one thing that I won't waste a lot of time on it, but stay away from insurance products. Unless you need car insurance or life insurance or long-term care, fine. But when they say do this and you can invest with us, I would stay away from those for things that we don't have time to go into today. Exchange traded products, those are in and out, that's pretty good, low cost. They have a tax efficiency outside of an IRA that we won't have time to go into, but they're a lot more efficient than some mutual fund that you bought and they buy and sell willy-nilly and you get the tax bill even though you put your dividends back in. That's not a lot of fun, right? So we would rather be tax efficient, lower cost, and also if you have 10 to 12 different funds that do things differently, for reasons I can't specify, we want to have different companies. You want to see in your portfolio that there's Vanguard, there's Fidelity, there's Schwab, there's iShares. there's Wisdom Tree, there's Invesco, a variety of companies. Maybe somebody hacks Vanguard, and it's not that they're going to run off with the money, but maybe they mess the system up, that you went to your brokerage account and wanted to sell that Vanguard fund to get some money, and now they can't get it to you. That would be scary. I don't believe that you would lose it in the long term, but they can really make things difficult. So Vanguard is great, lowest cost, biggest company. If you don't go with anybody, go with Vanguard, right? But I don't want all my eggs in that basket, and most of their funds are index funds, although they do have some good managed funds. I'd like to filter through Schwab, because some of them have high cost, but you can find the low expenses on the exchange traded funds, but they have old mutual funds that'll gouge you, and Fidelity has old mutual funds that'll gouge you if you don't stay away from them. Look for their lowest cost. Fidelity has some of the lowest cost funds only because they have some of the highest costs. And they've competed with Vanguard to try to take their business. So then you send it to Fidelity, but you better watch out. Some of those funds can have high expenses. However, they might be really good funds. So when you go into something other than an index fund, start looking at the cost. Cost is high. Okay, not a problem, but I want to see that mountain chart. Are you above everybody else? Or are you a lot less downside? Do you give me something for this high fee? Nothing wrong with that. If you want to go buy custom clothes, it's going to cost you 4 times as much, but if you want to do that, you can do it. If you want to fly first class, you want to make that expense. But in funds, we don't want to pay a high expense unless there's a reason for doing that. And we run into people all the time that have old funds with high expenses. We saw a client yesterday, potential client, that has one of his funds charged 1.57%. Holy cow. And then you look at the mountain chart, he didn't blow everybody away. I mean, if you were like a Bitcoin and you all this digital stuff and blew everybody away, I'll pay you 2%. But if there's no value there, why would you do that? And in all the other funds that he had, they inherited these funds. They had expense ratios of, on average, probably 0.80 or so. That's up there. We have a couple like that, but we can see that the tail is in the tape, right? The mountain chart is way up and they're not down as much. And man, these people are so good, they can demand 0.80. That's fine, I'm happy to pay it, but not if they're just an index fund. That would be ridiculous. Nash wouldn't remember this, but I do, that a lot of these investment companies had S&P 500 funds with an expense ratio of 1.5%, because they could, right? Yeah. Not anymore. You can't get away with that. So the exchange traded mutual fund era and industry is very competitive, and so at least look at that area, just because everybody's battling each other. Nobody's going to charge you ridiculous fees, and if they do, you can look it up, and if they do, you'll find out about it.
Can I ask you a quick question?
Yeah.
I have some Fidelity mutual funds, and it wasn't, I guess I'll call it my homework, although I didn't work very hard that day.
Okay.
And I thought, what are these fees? You know, I looked at the fee, what are these fees? And I really couldn't find anything that told me where the fees are. Is there a quick reference to say, so you get an idea what the fee is of a given? And I looked up the stock, you know, the ticker tape thing, and I, you know, what is the fee on this thing? I couldn't find the fee.
Yeah, so the fee will be reported as annual expense ratio. So anywhere you
see, where was it? I looked at it was on the Fidelity, and I was looking at what the heck? How do I find what the fee is? What's this fund? And I couldn't find anything about the actual fund.
You should be able to find it fairly easily if you go on the Fidelity website and find that specific fund. So if you have a fund in mind, I can find it.
They have to list it for you on there, but if it's too daunting and too much work, just Google the fund and say XYZ funds fee, and somebody will have done the work for you, because you have to look through a prospectus, and that's several pages.
Yeah, a long time ago, you could get something and you actually have the prospectus.
Yeah.
And maybe if I looked at, I didn't even think about it. Maybe I said, if I looked at it and said, give me the perspective for this.
Yeah, they have them online, and you can look up on the directory down here where it's fees and expenses, and you'll see it if you want to take the time. Yeah. If you don't, just Google it and somebody will tell you.
Yeah, so I know at least 4 different places you should be able to find it. Yahoo Finance will let you know. Morningstar will let you know. They give you a certain amount of information for free. Expense ratio is one of those things. Google Finance should tell you, and so will Market Watch. So any of like your standard, like free stock information places, Yahoo Finance is fine, Google Finances is fine, Morningstar is pretty good. And they give you a decent amount of information for free. They don't give you all their analysis and all those sorts of things, but the basic info Morningstar will have without having to make any counter.
And while we're at it, if you're really into this, go to ETF.com, ETF.com. And if you look at it long enough and you're into it, you'll figure out how to screen some of the funds, and that will tell you fees. But that's a really good site for people that want to be up on ETFs, exchange traded funds. And if you want to listen to a podcast, just for fun, every Tuesday is ETF Prime? Okay, ETF Prime podcast. So podcast ETF Prime. Every Tuesday they do one. Very nice gentleman, interviews people and talks about everything that's happening in the exchange traded fund market. But it's kind of like if we were going to have a little market here and they haven't set it up yet, we're all talking about it. It's fun to know what's going on.
Should I ask?
Yeah.
You get wrapped here. In just regular stock, I own a stock that's in my name. It's not through a brokerage, and they send the dividend reports directly to me, which I guess is old-fashioned. Can you do that with ETFs?
I don't think so. You have to buy it in a brokerage account, don't you? I've never heard.
Well, I mean, I would imagine it would be similar to as if you direct held a mutual fund, which is possible. I don't know about ETFs specifically, but I would imagine that there's something like that.
I don't know about that, because the whole point of it is what's ETF stand for? Exchange traded fund, so it would have to be on the exchange.
Right, but at the same time, a stock is exchange traded. So that can be direct held, I would imagine the ETF can.
Yeah, look it up, let us know at that
Thank you
point.
so much.
Yeah, if you have a brokerage account, if you have that stock and other stocks, you can put them in it.
Yeah, I don't. I just
Okay.
own it.
Okay, just own it through the company.
It rolls over, it just reinvests.
Okay, yeah. If it's a good stock that you like and the dividend, you could either buy more shares or you could take the cash of the dividends. That is the old-fashioned way, nothing wrong with it, because you can buy mutual funds from Vanguard the same way.
Oh, okay.
And they still have to send out a physical prospectus, but mine comes on a little postcard now, and it gives you a reference to the website and things.
So you're right, it doesn't look like you can directly hold an ETF. You can directly hold a mutual fund because that's how the transaction
Yeah.
works for the most part, although they can also be held in a brokerage account. And you can also directly hold a stock through a DSP or a direct stock plan.
Yeah.
But you cannot directly hold an ETF.
Okay. What's DST stand for, do you know?
DST?
Yeah.
I don't know.
There's an intermediary, so when you own a stock and you get the statement, you get the dividends, there's another company that does all the paperwork for the stock company, and then they send it to you. But they would probably prefer people own it in their brokerage account to reduce their fees and expenses, I guess. But in this case, we found out we can't own an exchange traded fund directly. You can own a mutual fund, and there's nothing wrong with a low-cost mutual fund through Vanguard. And there's nothing wrong with Schwab and Fidelity. Fidelity has some of the best funds out there, but they sell in bulk, and so they have some old funds that they're not going to reduce the fees much. Why would you if people are paying it, right? If your tenants are paying your top dollar, you're not going to cut the rent, although I have when the market tanks because I don't want to lose the tenants. But some companies are actually taking their old exchange or old mutual funds and either replicating them as an exchange traded fund because they don't want to miss out, or some are actually allowing you to convert the shares from your old mutual fund to their new mirror image exchange traded fund. You trade your stocks for theirs, but it's very rare, but that's what they're having to do because people like us are saying don't buy mutual funds. There are exceptions to that. If you don't want to have a brokerage account, go directly, not a problem. But now they're making you buy it online anyway. So, but a brokerage account lets you buy Vanguard. Wait, I can buy Fidelity, I can buy Schwab, I can do whatever I want. But whoever creates that brokerage account has to make a living. And if they're not charging you $7 or $10 per trade, how are they getting paid? Well, whoever's mutual fund you just bought through Schwab, or whoever's exchange traded fund you bought through Schwab, if it's not a Schwab account where they get paid the management fee, they take part of that company's management fee. So if an outsider says, Schwab, would you put our ETF on your platform? Schwab says, fine. What's your management fee? 0.10. Okay, give us 0.01. Is that 10%? So Schwab wants part of the management fee because they're the ones that are selling. It's kind of like selling your house through a broker type thing. Somebody makes little spreads and things like that. It's not a ripoff. It's cheaper to go through a brokerage account. If you don't do any trades, they might charge you $50 a year. And be careful, there are some exchange traded funds that can cost as much as $80 to buy, so you want to avoid those. But if you've got Schwab or you've got Fidelity or whoever and you're buying their competitor's fund, they have a deal with that competitor to give them a little bit on that. And if they don't, they will charge you $10 or $20 to buy that Vanguard fund when Vanguard won't pay Schwab part of the management fee. That's just the cost of doing business. So just be diversified. Companies, funds, internal securities. Because we never know what's going to take a hit. We talked about these things before. Short-term, intermediate, long-term positions in one portfolio or 3 different portfolios. If you got a bunch of money at the bank and you want to keep it there, that's part of it. And you could have 3 different portfolios. This is one at the bank. This is one if I need to start drawing my IRA stuff soon or I have an emergency. And this other one is what if I live way too long and inflation goes up. So you could do all these in one or several different. Lateral and vertical integration. There's things that we like to look at, and this is kind of backwards. The stage 1 is over on the right side. This is money that you put in for 0 to 5 years. CDs, T-bills, banks, we talked about. Stage 2 is over on the left, and those would be more like intermediate term bond funds, meaning they'll buy bonds that have a little bit longer maturity, but you can buy and sell them. A balance fund that you can take some bruising, and then the long term is in the middle, individual long-term bonds, nothing wrong with that if you know what you're doing. Individual stocks, nothing wrong with them, but you really need to know what you're doing and why you're doing it, because individual stocks can crash and burn or they can be very volatile. So that's why, unless you're really into it, I would stay with an exchange traded mutual fund. Managed mutual funds, T. Rowe Price, we've heard of them. They have one that's really good. And the only reason it's really good is it's been there doing the same thing a long time. Is Warren Buffett really good in the short term? No, he's no better than anybody else in the next 3 months. He doesn't know anything that no one knows. But in the long term, his fundamentals paid off long term, and he stayed with it, and he's done well. But he'll tell you he's had some real losers before. So he does proper strategic investing and financial planning, and people stay with those companies long term. Yes, it turns out that you can do quite well, but in the short term, we want to make sure you've got cash reserves, you've got backups, so you can leave your long-term stock funds alone and give them time to come back. Because if you have an exchange-traded mutual fund that has at least 25, but maybe 100 or 200 stocks in it, if they've done a good job of screening them based on the level of fund it is, if it's an index fund, somebody else has created the screening. If it's a factors-based ETF, then they've set up some parameters to do basic screening, or if it's a managed fund, then they buy and sell based on intuition. And that's the only problem I have with managers is if they're going to be buying and selling based on how smart they are, no human being is that smart, right? And how can you outsmart human behavior? That's the thing, is what's going to happen today or tomorrow is based on human behavior or computers that were programmed by humans, right? AI is a big deal, but I just saw the movie 2001. Remember that?
Yeah.
Oh, great movie.
How went rogue.
Yeah, went rogue. It's amazing. And this was 1968.
Yeah.
And one's sitting there and they're flying on that spaceship that looked like an airline, and the guy's sitting behind the seat of somebody else. There's a square flat screen color TV. 1968. We didn't get this stuff until when? They've been sitting on this technology for all these years. So it's not that I'm not afraid of AI, it's just been around forever, at least the concept of it. Very interesting. So short-term, intermediate, long-term, these are some of the concepts there. The vertical integration, bottom up, we talked a little bit about, but more specifically, if you look at that, think of that pyramid, if you look at all your investments, the baseline we would like to recommend is the index funds, preferably total stock market, total bond market index funds. And if you don't agree with styles and strategies and managers, just keep everything in a total stock market, total bond market index fund, right? The only problem is in the total bond market index 2 years ago, they had some long-term bonds in there and intermediate terms, and they took a hit. The index fund's not going to do anything in preparation to protect you. You own one of everything, that's it. And so if you say, well, the heck with it, I'm a 10-year, 20-year investor, I'm not even going to look at this again. The people that had a total bond market index fund that dropped 10 to 20% have somewhat recovered and are reinvesting. They'll be fine 5 years hence. But in the short term, if you buy a total stock market or the S&P or a total bond market, you're on for the ride. This is a cruise ship and you don't care what the waves are like. I'm just going to go with it because I don't believe in managers and I want the cheapest fund you can get. Vanguard's S&P 500 fund might have an expense ratio of 0.04, 0.05, but the cheapest one that you can get is what, Nash? What have you found?
Total market, it's about 1.5 basis points.
1.5 or 0.015?
Basis points,
Basis
1.5
points.
basis points.
Okay, basis point is 1% of 100, right, or 1 of 100. So in numbers it would be 0.15, but or 1.5.
0.015.
0.015. Super low, almost non-existent. There are exchange traded funds out there that don't charge anything, but there's always a catch. So you get a toaster if you come there and buy their other high cost funds. So the base of the pyramid is low cost, S&P 500, but more specifically total stock market, meaning 1,800 to 2,000 stocks in it, one of everything, and then one of all the bonds, short-term, intermediate, long-term, government bonds, corporate, and you just say, forget it. I just want to buy one of everything. We do portfolios with that as a base. We would like more index funds that are cheaper as a core to bring our temperature down, meaning bring our cost expenses down. And then if we have these really cheap, then we can afford to pick a couple managed funds that we think are worth paying a higher fee. We just don't want high fees. The second part of the pyramid, smaller group, are specialized funds that might be index funds, but in a special sector, a utility sector index fund, or an energy sector, or computer sector, or healthcare sector. There are several of them out there that they focus more on that specific area. So what I've been doing in the last year, not that I know that it's going to go up, but everything was up and utilities were down. I'm not ready to look at real estate again in a fund, but utilities were down, right? So when a client had too much money in one of their funds and we rebalanced it, we looked around and said, buy that utility fund or add to that utility fund. It's down 15%, but it's paying 3.5%. So we would rebalance into a utility stock index fund. This one is with Vanguard or Fidelity. And not that I know it's going to go up, but it's down. It's a good buy, paying 3.5%. We would like to increase that little section, that little sector of the economy. And so that's in our second level. It doesn't have one of everything. It has one of its own sector of those areas I talked about. Real estate is one of these days, the Vanguard Real Estate Fund or the Fidelity Real Estate Fund, I don't know if Schwab has one, but those might be considered. When you get the worst possible news, the most frequent times, now it's time to look at something because the price is beaten down because nobody wants it. It doesn't mean they're not getting rents from tenants. It's everybody saying real estate's going to crash. Well, real estate should have already crashed, but if they're saying it's going to crash, prices are going to come down. So if you have a PhD in human psychology, go for it, because in the short term, it's all about human behavior. Long term, real estate will be fine. The income's good. They're not all office buildings. They have warehouses, they have cell towers, they have all kinds of different stuff. So it's not the argument that, oh no, don't go into a real estate fund, meaning exchange traded mutual fund, not a public partnership or a private partnership. That may come that it was bad, but it's already taken a hit. And so the yields look good, and the Fed's not dropping interest rates, probably not going to this year. When we thought they were going to drop interest rates, a lot of money piled into the stock market, right? Now that we see that they might not, some money's leaving, but we're up more than we were before, right? But you want to do the opposite. Keep your short-term money available, but if you're going to take long-term plays, do the opposite and stay diversified. Utilities are still down a little bit, but I always like to look around and see what's down a lot that is a legitimate investment. So broad markets, there's no specialization. The second area is specialized index funds in sectors, or index funds that do mild management, not a huge fee, but instead of 0.05 charges 0.15. But every quarter they're going to rebalance it. Or they're only going to pick the top dividend-paying stocks in the S&P 500. Or they're going to do something that requires somebody to go out and check on the crops, so to speak, right? They're going to trim the plants. They're going to do something, then they're going to leave, but it's minimal, so the fees should be anywhere from 0.15 to 0.35 at that point. Then you get at the top of the pyramid, and who's at the top, smallest portion? Those are the managed funds that are really good. And really good is pretty much historical figures, and we believe in what they're doing, and we think they're watching out for us, right? Do you have any managed funds you like?
Only a couple. The two main ones for me are Franklin Dynatech and T. Rowe Price All Cap Opportunities Fund.
Okay, all cap means all capitalization size, meaning small, mid, large. And there's tons of other authors out there that will give you their opinions. But if you look at the mountain chart on the way up or maybe on the way down, you'll find that they've outperformed their index that is similar to what they do. So when you go to Morningstar, they'll compare your fund to an index that is similar. So if you have an S&P 500 fund and you're compared to the S&P, well, you're an index fund. Your fee should be super, super, super low, and your performance should be almost exactly the same. Yeah.
So are these two integrated systems really different, or how do you, and no pun intended, how do you integrate these two systems to make the whole picture? I'm trying to see, are they different systems or part of the same, or kind of a Venn diagram as far as an explanation goes?
They're integrated.
So pretty much the way they each address two different types of risk. So there is your first level of risk, which is just simply volatility at a basic level. And we're just not thinking about like individual company risk, we're not thinking about country risk, any super specifics. We're just thinking about volatility levels.
Okay.
That's where lateral integration comes into play.
So that's just the skeleton, that's just the...
Yeah, that's more like when an advisor asks you about risk tolerance or you fill out one of those questionnaires, that's basically what lateral integration is looking at, is looking at, okay, so you have some funds that are low volatility, you have some funds that are middle volatility, and you have some funds that are high volatility. All for those different reasons. For low volatility for current cash needs, medium for a little bit of growth, maybe some yield, and then long term for things that you expect to not need for a while. Whereas vertically, what we're trying to do is we're trying to diversify across a lot of other types of risks. So that could be credit rating of bonds, that could be types of companies and types of sectors. And the other thing that vertical integration allows us to do is to have more control of the positions in the portfolio. Because if all I was going to do was lateral integration, I would have cash, bonds, and total market index, and then I'd have a NASDAQ fund. And I can't really do a lot of movement within there. So if I am a little bit more diversified in my positions, I have a couple different sectors where ultimately these sectors are still part of the total market. But it allows me that if a certain sector has a long run or a certain sector is just not looking like it's going to be good for the next while, I have more flexibility in the ways that I can position and maneuver around inside of the portfolio. So it can be partially how you want to specifically weight, and also it gives you more control because you have more positions to move from place to place.
So lateral integration seems strategic, and vertical integration seems more like tactical.
I would say that's pretty accurate.
I'm just trying to see how to...
Yeah, absolutely, and
Okay.
it's a frame of mind, although he does have some portfolios that have all those components in it. But just keep in mind, if you create a portfolio, how much do I have for short-term, intermediate, long-term, just in case, and then do I have too many managed funds? I want
Gotcha.
more of this, more of this.
Okay.
And we put in the book, 45% total market, 40% here, 15% there, just as a guideline. So you're not paying too much in fees and you don't have everything loaded up over here. But Nash has a system that only he can keep up with. It keeps it balanced within that kind of stuff. But mine is general stuff. Because if we talked to a client recently, he said, okay, well, he's got all his investment accounts invested tax-wise the reverse of what he should. He's drawing money out of an IRA, drawing money out of a brokerage account or whatever, and then leaving the Roth and the other IRAs alone or whatever. We want to come back and say, look, draw it out of the bank, in the brokerage account, and you just inherited this money, so you may not have a lot of taxes because you get a step up in basis. So his strategy was pretty much off. But once we realized that if we need to go back to the brokerage account, which is all growth mutual funds and high fees, and they're turning things over and he's paying a lot of taxes as he goes, maybe even if we kept this, you need to get rid of some funds and start backfilling. It's kind of like your foundation's doing this. We need to backfill it and level it out. And so you're absolutely right, strategic along those boundaries and things.
Gotcha.
And kind of things to keep in mind, because we want to make sure, our main goal is to have good funds that have good performance, but why would you pay more than you need to on the expense ratio? You do it yourself, save some money, or you go to Vanguard and say, hey, help me out, I've got X amount, tell me some funds to buy, here's my objective and risk. Or you want to have somebody that's really obsessed with this stuff, then you pay an advisor. And there's a lot of advisors out there that do things where they say, hey, come with me, I'll balance all this stuff up and do a great job. They'll ask you all the questions, you'll sign the form, and they'll send the money to the home office. And some manager who's created a model system that are all the same, who's never met you, they have no idea what your political beliefs are, your risk tolerance as far as cringeworthiness and all that stuff, they'll put you in whichever bucket matches that. And we found out recently that a lot of these buckets have all the same company, like this one had all iShares. Well, nothing wrong with iShares, but for the reasons we mentioned, we want some diversity in there to be safe. So if you go with somebody, the point is the advisor says, hey, I'll take you to lunch, we have a relationship, and I'll take your money and I'll ship it to the home office, and they'll charge you the full asset management fee, but the advisor's not doing the work. And we believe the advisor needs to do the work and know the funds intimately and know why you're in any one place. And if they don't do that, they're doing what we call is reverse churning. It's not we, but the industry. But if you have a computer rebalancing, oh yeah, we're doing something, I can charge a fee. No, you're not. They need to manage the money and do the work with the client and go through all of those levels of the diagnostics and check in occasionally. Each year, how are you doing with this? How are you doing with that? And everything that we know, we share with the client if they don't want to do it. If you want to do it, it's all in the book, step by step. But watch out for advisors who want to charge you a fee and you say, do you personally manage the portfolio? Well, no, we got a PhD person at the home office. That's just them wanting to scale the business, bring in as much money as possible, let the computers do the rebalancing. We'll tell the computers occasionally what to do, and now we can bring in more and more and more money. That's how banks get rich. Nothing wrong with it if that's what you want to accept. Or if their fee is half as much, okay, I'll do what's that one, a robo-advisor? Sure. Yeah, you just put your money in and you tell them what you want, they'll pick the funds and rebalance them. I haven't found the funds to be that great. But. So, level 2 we mentioned, and examples of level 2. Other ones might be specialized funds, ESG, environmental, social governance, restrictions. Smart beta is passively managed. Index funds, like I mentioned, strategic beta, rules-based. Maybe they every quarter they do something, or they exclude this and include that. Multi-factors, you've got all these different things that if you want to go beyond that 0.04 total market index fund expense, for a little bit more, you can get all these types of funds. If any of these plans and strategies are what you want to do, then you buy a fund, but it won't be 0.05, it'll be 0.15, 0.20, 0.25, whatever. We don't want it to be egregious. There are buffer funds, minimal volatility funds that it isn't a magical thing they're offering to you free, but if I look for a minimal volatility, I'm looking for a fund that has a history of less volatility, but it's not because they're just nice guys and gals, it's because they're buying the stocks that have less historical volatility. And there's no guarantee they'll continue to do that. But if I just want, okay, I just want to get minimal volatile stocks. They're still going to drop a lot, maybe 75% as much, don't know. And then there's low volatile stocks. Well, what's the difference between minimal and low? The low volatile stocks are the real boring high dividend funds that you say, look, I want to be in that fund. If the S&P goes up 25%, I might be up 8 or 9. I'm just going to own these old companies that have big dividends that are not expanding and borrowing. And if they go up with inflation, fine, but I'm getting 4.5%, 5% yield. And if interest rates go down, my yield doesn't necessarily go down because they're paying me out of their pocket. It's not a loan or anything like that. But you want to become familiar with what all these things are, and these are listed in the book, and you can get into that if you want to. Thematic ETFs focus on a theme, so a philosophy, cyber security, Bitcoin, cannabis, pet supply. So if you want to go into an area that is something you're passionate about, there's an ETF for you. Why? Because they want to get the fee to manage it, right? And there's not a huge fee. The smaller the fund, the higher the fee, because they have to pay like $300,000 to $500,000 a year just to stay in business. And an exchange traded fund can close. So that's why Nash makes sure that I buy exchange traded funds for clients that have a high volume. If they have a low volume, not a lot of people buying and selling. Even if it's an S&P 500 fund from a new little company, perfect stocks, but if they didn't get enough money coming in, they can't keep the doors open. So then they bought it, thing doubled in value, you love them, but they still didn't raise enough money. Guess what they do? They sell all the stocks and give you the cash. Well, you just went up, doubled, and now you've got a tax problem. But if you have the S&P with a big company, they're not going to do that. But a little tiny company might have to close shop, not that you would lose the stocks, but you might have to sell stocks and pay a capital gains tax if they're up. Or if they're down and you don't want them to sell, they might be forced to do that. Let's see. The top one, well managed, like we mentioned, offer defensive management, represent very volatile and sensitive sectors, areas of the economy. Best performing funds might charge a lower fund expense than most because maybe they've raised a lot of money. If you've got billions of dollars, you can bring your costs down. So that's a benefit of big ones. Usually, when you're looking at funds, the bigger the better for the expenses. The smaller the better for the agility. So if you've got total market index funds, you want the biggest funds out there because you get the cost down. But if you want a specialized managed fund, you want a small fund, reasonable fees, but they're doing what you want them to do, and you're happy with them. That's okay. But they can't afford to give it away. They're going to charge a lot more, especially if they have to fly all over the place. Examples, bond funds, and preferred stocks, emerging markets, new areas, Bitcoin, growth, anything like that. We prefer to use managed funds with bonds simply because there's not as much market liquidity for that. So Vanguard's good with bonds. I'm sure Fidelity and Schwab is fine. We use those as well. And PIMCO is a managed bond fund company, Pacific Investment Management Company, PIMCO. Some of their funds they do some unusual strategies and they outperform the market. And the one thing you want to stay away from is if whoever it is, stock or bond fund, is outperforming the market, but you don't know what they're doing, you want to find out. Because they might be pushing things to the edge, to the edge, to the edge, and then boom, 1 year it doesn't go their way. So read up on why this fund is a 5-star gold rated fund, outperformed everybody, that's okay. Just read Morningstar's description or read somebody else's analysis. Because PIMCO would outperform everybody, but they were out buying student loans and loans on cars, loans on bicycles, whatever. They were doing all this alternative loan business, and it's really great until it's not. Or if it drops and you're okay with that, you want it to recover.
So are most bond funds just a section of all bonds, short-term, intermediate, and long-term? Is that usually when you have a managed fund, they're going between those three choices?
They can pretty much do anything they want, but you could have a short-term bond fund.
Okay, if it says it, that's what you're looking
Yeah,
at.
I don't know, a total return bond fund would have a little bit of everything, and the manager can go to long-term, go to short-term. If they went to long-term recently thinking rates are going down, they were wrong, and they're down
Right.
1 or 2%.
Right.
Or if they went long-term 2 years ago, they lost 20%, maybe 30% on some of those bonds. But a total return bond fund would do anything they want. But if you want to be more specific, you could get a short-term intermediate, Ginnie Mae's, treasuries, whatever. And if you don't want them managing it much, then it's better just to get an index fund. Short-term treasury index fund will just buy one of everything, and you don't risk somebody making a mistake.
And I guess that's my question, index fund just across the spectrum
Yes,
box? Okay.
yeah. But if you want to get a high yield and you want to go to junk bonds, do you have any favorites?
Not really any favorites. I've been using Vanguard's high yield corporate.
Okay.
It has a decent yield.
Is that a managed or an index?
I believe it's an index, but
Yeah.
I'm not.
The pros and cons there, the index usually will give you thousands of bonds and expecting 5 to 6% going default, but because everything has a high yield, you're okay. If you did nothing but buy junk bonds for the last 4 years, you're in great shape because they survived, they paid super high yields, they crashed, they survived, and nothing wrong. But going forward, it's like, I don't want to do this too much. So we have a layout in the book that we just say, look, no more than 10% in a high yield bond fund, no more than this, those are just guesses. But a managed high yield fund is not a bad idea because if the market crashes, maybe there's not as many buyers for a low credit rated junk bonds. So maybe you want a managed high yield fund to be safe, or a really big index fund with Vanguard. So Vanguard's a non-managed index fund to get the cost down, but it could predictably lose 5 or 6% a year maybe. And a managed fund, if you think this manager is so smart, they're going to avoid that 6% drawdown, maybe you find a manager. Jeffrey Gunlack is with, if you ever want to look up anybody, Jeffrey Gunlack's a pretty smart guy. He's with Double Line Funds. He always has a really good story to tell. But PIMCO is a good manager of bonds and things like that. They specialize in it. But they can also, they know where to buy the bonds or where to sell the bonds. And if you just have a standard bond fund and the market goes up or down, I want those managers to be tied into all the connections because they're not as liquid. So if you were to sell your house in a bad market, you probably want to sell it through a broker who has huge contacts and can find somebody to buy your house, even an investor. Whereas if you don't want the kid down the street that's brand new trying to sell your house in a bad market. So a bond fund manager, if it's at all risky, then possibly that would be wise, or a super big index fund. Preferred stocks, their prices took a hit recently. Those are stocks that a company pays that says, you own this stock and we pay you our dividend as a preferred stockholder. If we increase our profits in the future, we'll increase your dividend. So you're not there to make money on the resale of the common stock, you're there to get the income off the stock. But it's kind of like you're a stockholder, you have a right to the income, but it's not guaranteed like a bond is. If they go bankrupt, the stockholders lose, preferred stockholders lose, then they come down to the bonds. And then last person to lose would be the IRS, right? So bonds, preferred stocks, emerging markets. In my career, we've never had a good run on emerging markets. Used to be like Vietnam, China used to be an emerging market, India. Whatever the small companies are, the good thing about them is, though, they're not heavily in debt like the US. They don't sell a lot of bonds. But they do have uncertainties and political issues, and all that can be a problem. I always hear the analysts say, but one of these days, emerging markets is going to be where it's at. So if you want to gamble something in a diversified fund, and you can even get probably an index emerging market, just be patient. It's going to go up and down, and one of these years you may have a really good run. We try to keep a couple percent there, but I just haven't seen anything be consistent. But as soon as something's not consistent, we get out, it goes straight through the roof, right? So make sure it's a part of the allocation that you're going to be patient with. Emerging markets, new areas, obviously Bitcoin and all that kind of stuff. We see the blockchain as being a big part of the economy. Bitcoin I'm going to guess is somewhat of a program that might be used in the future, and if we use a lot of it, yeah, those Bitcoins can go up. But who's to say they don't decide to print more coins? They're reducing them now. More rules-based investing. When you're investing, diversify among securities funds and companies, like we said. That's important. And you can do that in a brokerage account at Vanguard, at Fidelity. We use National Financial, which is under Fidelity, for investment advisors. And then Schwab and whoever else has them. Robinhood is one. What's the other? Intraday and all that stuff in brokerage accounts.
Well, there's quite a few.
Okay. You can do them all on your phone if you want, right?
Yeah.
Would you stay with a big company just in case?
I mean, well, see, the thing is, even the smaller firms are owned by the bigger firms for the most part, or a lot of times. Like Robinhood, for example, isn't actually really its own brokerage company. They do what's called payment for order flow. So they actually offload all of their transactions to a bigger firm that actually processes everything for them.
And now they tell us about that. For a while, they secretly did it, and they got in trouble for that.
Yeah.
The good thing about your SEC, Securities Exchange Commission, is they're out there to bring people down if they're breaking the rules. And so they didn't tell everybody that they took in the orders and sold them off to the side and kept part of the money, but now they paid a big fine and they have to disclose that. That's the good thing about the securities industry. When you buy into stocks and bonds today or tomorrow, you're not getting a good deal, but you're not getting a bad deal. You're just getting whatever the market says it's worth, minus a tiny fraction of a spread and all these little tiny things that you can't really see. It's not real expensive. And while you sit your money in cash at Schwab or anywhere else, you might earn 1%, but they're keeping 2, 3, 4% for themselves. So Schwab makes money, other brokers make money. Keeping money in cash as a bank, and you're not using it, they are, or they're lending money for people to buy on trades, on margin, you get to leverage or borrow. And then these little tiny fees that they charge the companies to be on their platform, and other things that I can't think of right now, but they're pretty well disclosed. So I would stay with something that's publicly traded, the SEC's protecting you. It'll be a good buy if you buy something now and it goes up, right? And maybe it's not as popular now, so you're going to be looking at it. Is it time to get back into long-term bonds? I don't know. Maybe a year from now when interest rates are going to come down, I don't know. But that's everything. It's an unknown, right? If you want it to be known, put it in a money market fund, Vanguard Treasury Money Market Fund, and you'll know that it owns T-bills and you're going to get 4.5%, 5%. But the unknown is, how long will I get that? Is it going to last 2 weeks? Is it going to last a month? Is it going to go down? But just the yield goes down, so you don't have to panic. But in the long term, what is that dollar for dollar going to buy when inflation goes up? So there is no guarantee thing out there. And if you know that it's guaranteed, people that know that are probably breaking the rules. So the other things are, when you buy, we want to be diversified like we mentioned. We want low standard deviation. We mentioned that. That's a historical volatility from the norm. From the norm, I learned from Nash. I just thought it was volatility. And then low beta. Beta was the risk compared to whatever index. So if I want to compare my beta to the S&P 500, if theirs is a 1, then if I'm a 0.5, then I'm hoping that when they're down 10%, I might only be down 5, but it's not a guarantee. It gives me a historical comparison. So we want diversification, low standard deviation, for most of us in a nest egg investment. If you're aggressive, then you want high risk. Low beta, high alpha, that's like a little extra return that most people get in our category. Maybe because we're picking lower cost funds, maybe we pick funds that did some strategy and this year they performed, but looking for alpha is not a long-term guaranteed thing. Right now, gold would have a lot of alpha, a lot of higher rate of return, but 2 years from now it could be negative, so we want to be careful. Or if you say, buy our S&P 500 fund, we have 90% S&P and 10% gold, you're loving them right now. They're great. They have good alpha. But 3 years from now, they might not. So be careful when somebody's talking about that. Moderate to high rated bonds. Although junk bonds are great for yield, nothing wrong with it, but most of us, we don't want to load up on that because they can drop just like stocks. And if you get panicked and a big decline, be careful with that. Low bond duration, that's how much will this bond drop or bond fund drop if interest rates go up, right? So in the last few years, we wanted a duration of not more than 3.5 years, meaning if rates go up 1%, the fund would drop 3.5%. If it goes up 2%, we could be down 6 or 7, watch out. But then if they're short-term bonds, then they come back because the bonds finally mature. 2 years ago, a lot of inexperienced advisors and investors had clients in a total bond market index and they dropped 20%. The long-term bonds dropped 40% when the Fed had to raise interest rates to slow inflation. We knew this. Why? Because I started in 1980. Do you remember what interest rates were back then?
17%.
Yeah, by 81, 82, money market funds were paying 18%. Oppenheimer had a money market fund paying 18%. But it didn't last long. It crashed to half that once it hit its peak. So we want to just look at what we're doing and take the yield relative to the risks that you want to take. But if we have long-term bonds and rates go up, they'll drop a lot. But what if we say, 2 years ago, we knew that interest rates were at the lowest they could be, so why would you buy long-term bonds at 1% or 2%? Not only are you going to earn less, when rates go back up, your bonds can't be sold. So now, I'm not saying this, but if you say, okay, the Fed's not going to raise interest rates, they're going to drop them, let's say next year, we thought it was going to happen 3 times this year, but once you say, okay, that's it, they're not going up any higher, then you can buy long-term bonds and lock in those yields, because if rates stay the same or go down, you'll keep them. But the risk is if they go up. Be aware of it. Long-term bonds are great for income. Pension plans will buy them no matter what the market is, because they have to guarantee income someday. If I won the lottery and I had $1 million and no other assets, long-term bonds would lock in my 4.5%. I get $45,000 a year for 30 years. And the treasury bonds, what do I got to worry about? Oh, rates went to 5. You can't sell them. I'm not selling. But if you want the liquidity, you don't want to lose anything in a down market when interest rates went up on bonds, then you want to start managing the duration. Low expenses, liquidity of funds. Mutual funds are only liquid at the end of the day. You can put in your order to sell it, but an exchange-traded mutual fund can be sold during the day. That could be good or bad. You might have sold it at the wrong time during the day, and you should have waited. I don't know. But some people say that ETFs, exchange-traded funds, are really good because you can buy and sell them anytime you want. Well, that could be a disaster, right? We remember the flash crash. And that's a whole other story, where a broker had mutual funds, ETFs, in a brokerage portfolio, and put an order in that if the market drops 10%, sell. The market dropped 50%, and he sold out, but at the end of the day, they recovered. And he sold out at like a 50% loss, and then they came back in one day. Who would have thought? Bad mistake, unfortunately. Anybody could make that mistake. So exchange-traded funds are great. They provide liquidity, but make sure if you're buying them like a stock that you put in the limit order and all the other things that will keep you from losing too much or selling at the wrong time. Tax-free versus tax-efficient funds for taxable accounts. We saw a client recently that had a brokerage account that had all these old mutual funds that had really high management expenses. They were really good funds in their day, but they charge 5.75% to buy in, and then the management fees are 1% plus. So they inherited them, so the mutual fund expense, the commission wasn't a problem because it was already paid, but the management fees were way too high, right? So they need to look at other funds that are lower, but wait, don't do anything yet until you look at the cost basis. Now, had they bought these mutual funds when they were really low price and they've grown a lot, even if they're overpriced, you need to see your account before you sell anything. But they inherited them in 2021 or so. But then again, the market went down in 2022, but it's up a lot now. So some of the funds might not be able to be sold without some capital gains, even from the time they inherited them. You got to be very careful that if you're selling anything outside of a retirement fund, within a brokerage account, in the retirement fund, if you don't take it out, that's not going to be taxable until you use the money. But in a brokerage account, if you sell something and buy something else, that's a sale. And so you need to, and you should have access to, we have access to, the original purchase price or cost basis. And then we can look at, is this going to trigger a gain or a loss? Now, some people tax harvest at the end of the year to sell something that's down in order to sell something that's up. In the moment, that could work. This is down, this is up, I'll sell this, it's down, this is up, and it'll be a break even, and I was able to get out of that one that was up a lot. Okay, great, now I can take the money or go do what I want. But that thing that was down, if you sold that and bought something else just like it, then when that thing goes up, you're going to have the capital gains all over again. So if I sell something that's down, I sell it and claim a capital loss, right? But if I reinvest it, because if I take the cash, no big deal, I have the loss, I lost the money. But I go, I don't want to lose it, I sell this because it's down and take the write-off. I buy this, and that goes up a lot. That thing's new cost basis is pretty low, so you're going to have capital gains to pay. Now, only exception to that is, I inherited all this stuff, I'm going to hold it for my grandkids or my kids, I'm going to sell this with a loss to get that with a gain, and I'm going to buy the same thing here in another fund and let it grow, but I'm not going to sell it for myself someday. My kids will get it and they won't pay a tax on it. Because right now, there's something called stepped up basis, that if you own an asset that goes up in value, like stocks and real estate in a business, and you die, you can leave it to somebody else and they don't pay any taxes on it. Retirement plans, yes, you pay taxes on it, but your house, if there's a taxable gain and you die and leave it to somebody, they inherit it tax-free, step-up basis, it's in the book. If you leave stocks or exchange-traded mutual funds to somebody, you have a lot of gain. If you're married, your partner inherits it directly, no taxes for them, right? Or family members, they get this stuff tax-free. Now, every few years they try to eliminate that tax benefit, but right now it still exists. It's bizarre because I have properties that I bought 25 years ago, 30 years ago, and okay, fine, I've got tenants. I love to just sell it and take the cash, but I would pay a whopping tax bill. But if I die and leave it to a beneficiary, they walk in, sell it, they have no taxes. That's backwards, right? So our new article on saving Social Security, found on our website soon, right? It talks about how to deal with that. Let's see. Tax efficient funds is the index fund. Which is more tax efficient, the index fund or the managed fund?
Index fund.
Yeah. The index fund, and preferably an ETF for little things. But an index fund with Vanguard that's not an ETF is tax efficient, but if they get a run on the money, they have to sell stuff. An ETF, if they get a run on the money, they don't have to sell anything. You just got to sell your shares to somebody else. So they're more tax efficient for the most part. So an index fund is more tax efficient. So as we found, in the IRAs or the Roth or whatever, that's where you have your high dividend paying stock funds or bond funds or whatever, because everything coming out is going to be taxed at ordinary income, not capital gains. So all your high dividend stuff in the IRA and the Roth, because you get to grow. But outside of the Roth, in your brokerage account, it's better to have tax efficient funds. Municipal bond funds, short-term, intermediate, long-term, tax-free money market funds, ultra short-term municipal bond funds, that's fine. And then tax-efficient index funds, or Vanguard actually has a balanced tax-efficient fund where they try not to trigger too much taxes. But if you have more ETFs, they have the ability, if they feel the need to reposition a stock inside the fund, they can trade it for somebody else's stock and not trigger a capital gains. So in the retirement funds, high dividend stocks and or bond funds and cash. Outside in regular accounts would be tax efficient, exchange traded funds, index funds, things like that, if you don't want to pay a lot of capital gains. However, you don't pay capital gains on things you sell until your income gets up to, Nash?
Well, that depends. So for ordinary income, there'll be about $94,050.
A married partnership?
Yeah, for married, and I don't remember what the single number is.
Probably half.
Yeah.
I think.
So close to that.
So if there's a married partnership, then if their income is below 90,000, let's say they have 50,000 income, then they have another 50,000 or 40,000 in capital gains they could add to that and not pay any capital gains tax at all, right? But if the capital gains takes you over that 90,000, is it just the last leftovers that are taxed?
Yeah, so it works the same as your normal progressive tax rate. So
Okay.
if you have capital gains that get taxed at 0, it's only for that certain amount, and then the excess amount gets taxed at the next level, and then if that passes the next level.
Okay, so if your combined income is below 90,000, capital gains or ordinary income, there's a saying out there, capital gains does not, what was that saying? I forgot. The capital gains does not cause ordinary income taxes to be taxable. Right, combined if you're
It
below
doesn't
90.
increase ordinary income.
Doesn't increase ordinary income tax. But if your ordinary income goes too high, then it moves up the capital gains up to potentially taxable. Bottom line is, 90,000 or below, combined capital gains and ordinary income, a married partnership aren't going to pay capital gains on the stock. So if you have some of these mutual funds that are high expense and you have too many taxes and they're not in an IRA, don't go sell them all at once, see your accountant, but maybe the accountant says, yeah, you can sell off some this year and you won't pay any capital gains. And we can sell a little bit next year, no capital gains. Because the main thing we're trying to do is get the cost of the fund down. But why shoot yourself in the foot, right? So if you've got some perfectly good growth mutual funds and all these things, but their expenses are like 1% when you can get the same thing for a quarter of that, then see your accountant and say, how much can I sell off of these? And I'll go buy the same darn fund somewhere else, but have the accountant or you do your tax preparation ahead of time and know what you're doing because you'll get a trigger. Nobody here is old enough to use Medicare, but you don't want to, except me, you don't want to sell a bunch of things and have a bunch of taxes in a year in which you're drawing Medicare, or they'll raise your premium, right? And they'll do that for 2 years. So if you have a big annuity and you say, I'm retired, I'm 66, I'm 70, I'm drawing Medicare and Social Security, I'm going to go sell that annuity and cash it out and go on a cruise. If that pumps up your income, Medicare can raise your premiums for 2 years. So be careful about that. Tell people, or you do it, reposition stuff, have a higher tax bracket before you draw Medicare. See your accountant at that point. Let's see, balance. Here's some just simple ideas. Up to 10 different funds and ETFs, fund companies, Vanguard, Charles Schwab, Fidelity, T. Rowe Price, iShares, WisdomTree, Invesco, etc. So your portfolio should have a mixture of those. Up to 20 different funds if you have a lot of money. Total portfolio securities, this is just a guess. When we looked at it, an average balanced portfolio might have 3,600 stocks among all the funds. Bonds, they can be as high as 20,000 because they keep getting issued. There's only so many stocks out there, but the bonds keep issuing more bonds. And then just a theoretical portfolio, combined funds and allocations, you might have 2.6% in cash, right? Just from dividends or hanging out there or whatever you do. 52.4%, this is a conservative portfolio, short-term, ultra-short-term, intermediate bonds, let's say. We're not ready to look at long-term bonds. Other might be preferred stocks or convertible bonds, 7.62. Stocks might be 34.7, and then non-US 2.66. This is way on the conservative side. But if you have a big retirement from your employer and you're going to be fine with cost of living and you don't see it being a problem, then this portfolio might be 90% stocks. Always keep 10% when the market tanks and you have bragging rights. Oh, I bought more of this. But you don't want to invest everything and have it drop 25% and there's nothing you can do. So I encourage people to have 10 to 20% in cash or ultra short-term bonds or something. So when the market tanks, you can at least stay positive and say, I sold the bonds and bought more of what was down. Because when I go to rebalance portfolios, especially mine, I'll line them all up, and if they're all legitimately good funds, who's down the most and needs my rescue? Help, I'm down here, utilities, buy some more of me, and buy and rebalancing. That's about the only way I can control the future, because I don't know what's going to happen tomorrow, right? And so if you made a commitment, you like stocks and real estate. Vanguard has a real estate investment trust fund, ETF, and it's down a lot. Some people say it's too early, but let's say you buy some of it and it drops again, buy some more, and then it levels out, and then it goes up a lot, stop buying, it's too late, right? So it's not what you do, but it's how you do it. If you manage things properly for yourself, appropriately, the long term will be successful whether you beat the market or you didn't. Because if I want to be a balanced investor, and if I can get 8% a year, that's a big win when the stock market averaged 10. Small cap stocks averaged 12, but they had huge declines. Everything has strings attached. Small company stock funds, ETFs, have, in my opinion, average volatility of what I remember seeing, about 35%. Above and beyond the average gain. That's a lot, right? Then the mid-sized companies, we call that the sweet spot because they're not too big and too small, they're just right, but their average volatility might be 25%. So small cap, mid cap, you're going to be buying over time. Expect them to crash. Buy some more. When they hit the top of the mountain and enough time's gone by, maybe you sell. But small cap 35, mid cap 25, large cap, I'm going to round it down to 15%, but it's actually more like 17 or so. And then going beyond that, international, all those other things, you can look at that. So again, it's not some, if you choose not to do yourself, don't go to somebody who tells you how smart they are. Because by the time somebody, and like on these talk shows, oh, buy this, don't do this, they'll bring back the people that were right, and the ones that were wrong, they won't. But there's no person that can predict human behavior tomorrow, right? If we couldn't trade stocks for 10 years, then I might predict, I think this one's got a good earning practice, and doing this, and they're scaling that, and you can try to predict that in 10 years from now, or 5 years from now. But tomorrow on what people will do, or what the Fed will do, that's a joke. I watch that stuff while I'm exercising, and it's fun to know and stay current, but who knows how people are going to react. And all these experts a month ago were telling us that, oh, I'm bullish, keep going, get into the stock market, it's going to go up, up, up. They're going to drop interest rates 3 times. And now the Fed's saying, not so fast, inflation's back up again, we probably won't. If they do, they'll be accused of messing with politics. So you're probably not going to see an interest rate drop. And do you really want one to drop yet? Probably not, because then you have inflation pick up again. I'll leave that up to the Fed. But even the Fed is wrong a lot of times. Here's what I mentioned before. If you look at that pyramid, and it's in reverse here, it starts with 45% as the base, which I shot. I'm dyslexic, I should reverse this, but 45 is the base, the bottom. The 40% might be in the middle and 15 at the top. That's just kind of a best guess. Is total market index, factor-based indexes, and specialty low-cost ETFs, and then prima donnas up here. And there's a lot of really good funds out there, and in the past, people like Warren Buffett, and I forget his name with Fidelity's, that big fund years ago, they're heroes, they're so smart, but they just bought fundamentally good stocks and they hung on for a long time. Now, because technology jumps in there and can go way up or way down, it messes with the old fundamentals. But you could buy Microsoft when it hits a low as a second chance investor because they'll probably survive and keep going and they have a lot of money. I'm not into Tesla, but maybe Tesla or something like that as a second chance investor, but don't expect them to go from 0 to 60 in 2 seconds. They're just going to be good big stocks that you get exposure to technology, but not necessarily a lot. And speaking of that, why is my Intel not doing anything?
Well, Intel simply releases inferior products to both AMD and NVIDIA. They're just not as good.
Okay. I bought, the only stock I own, I bought a little Intel to help them out, you know, and they were down a lot. And everybody else is taking off and they're doing nothing. But it was a good reminder, don't buy individual stocks. Unless you're really into it, you don't mind the gamble, and when they tank, you get, well, that's because, and then you buy some more. But I like the funds because I get 25, 50, 200, and no matter whether it goes the right direction or the wrong direction, you're not going to lose your money. Your shares may drop in value, but I've never seen anybody lose shares of a fund, but I've seen people lose shares of a stock that went bankrupt, right? So unless you like gambling, nothing wrong with that. Save your trip to Reno, you can gamble all you want, but you can also gamble with exchange-traded mutual funds that can be wildly up and down. And there's always new ones coming out all the time. So have fun, but why risk losing the principal? Some other things about the portfolio, and this is listed in the book on page 170. Worst year performance, this is a sample portfolio, February 2008. This particular example, this fund was down 17.03, but it had a lot of bonds in it, so that's why, right? Because in the downward trend of 2008, February to February the next year, the stock market dropped as much as 65% and ended the year at a 50% decline and took 7 to 10 years to recover. So that's one argument of, you don't just buy the S&P because everybody else is doing it. If you were ready to retire, you needed the money now, you're in dire shape if you were down 50% and it took 7 years to recover. Yet you took our class and you had money in the short-term position and some in the intermediate, so that decline meant one thing: buy more, right? It didn't mean I'm in trouble, I'm going to sell it at 50% and I'm going to lose money. Buy more. You made that commitment, you have to do it. It's like bringing a horse home. You can't ignore it, right? Or a dog or something. So this one dropped 17, but it had a lot of bonds in it, that's why. It will not go up a lot when everybody else goes up. We've got to not expect the S&P 500 returns. Nobody looks at it when it's down 50%, but when it's up, it's like, well, why don't I get that kind of return? 2 years ago, it was down 38 and ended the year at 25% decline. That's a buy signal if it's a good investment, and it's in the right short-term, intermediate, long-term position. Last 12-month yield, this one had 2.2. This is old. 10-year standard deviation, 7.5% from its norm. I add that, thank you, Nash. Then 10-year Sharpe ratio. What's Sharpe ratio?
Sharpe ratio is really just, it's a measure of how much more positive return you got versus the standard deviation.
Compared to an index?
No, not compared to anything.
Okay,
so
just
it's
standard deviation.
only raw, like if you're using standard deviation, if you expect to be up 7.5% from whatever the mean return is of the asset, the Sharpe ratio is usually going to tell you how much extra you got on the positive side versus the negative side.
And is there usually a reason, or why wouldn't you just go look up the highest Sharpe ratio funds and just buy those?
Well, that depends on how you're using the Sharpe ratio. If you're using a 1 year, you're going to be fooling yourself. Because, I mean, for example, NVIDIA probably has a really good Sharpe ratio for the last year or two. But if you go back 5 years, 10 years, it may not be the same valuation.
Okay.
It may not be the same statistic. These numbers are, everything's historically based. None of these can cast forward.
So if you just want to feel better, low standard deviation, high Sharpe ratio, meaning good return, no guarantees, but it feels good. Close up your portfolio, done. I'll come back and look at it next month or every day, but at least you've got, let's say, 12 different funds, 6 different investment sponsors for reasons we can't think of. Each fund is a little different than each other. We have short-term cash, we have intermediate-term bruised money if we had to go more than that. We have long-term when the market tanks. We need to buy more. You have to do it or wait it out, do something like that. Base of the pyramid, I've got total market index funds to fit that short-term, intermediate, long-term. Then I have the ones in the middle, ones at the top, and these few big top ones that charge me 0.85. Every quarter we look and make sure it's worth it. And if it is, then good for them. The beta we talked about, R square, I'm just going to save us time and say, how similar is this fund to what, an index?
Yes.
Okay, is it similar to the index?
It's not that it's similar, it's how much of the movements that you're seeing in the stock price can be explained by the index.
Okay.
So you could have a portfolio that has, like this, a beta of less than 0.4, so it's not going to move as far as the index, but it's going to move in the same behavior as the index about 90% of the time.
And if this portfolio has bonds and stocks, it's not going to be the same as S&P or anything, but it moves, but not necessarily as far.
Right, so like I just said, if you have a low beta, it's not going to move as far as the index,
Okay.
but if you have a high R squared, it's going to have the same behavior.
Okay, and if we had Bitcoin and gold in there, then the R square would be a lot lower.
Possibly.
Okay. So we don't want to count on that 100%, but is this going to go up or down generally, but not down as much and up as much depending on what you have. But if you had a bunch of gold today, it'd probably have a low R square because it's totally different. Kind of like that non-correlated, right? Somewhat somewhat
Yeah.
like that. We want to have opposites, because in nature, right? Why do animals mate with different partners? It's nothing weird, it's that nature wants to diversify the gene pool. Some of the offspring die, some don't. So we want diversification because we can have some really bad days. We want to be able to say, I'm not selling that Schwab S&P 500 fund. I don't care, it's down 50%. Schwab didn't do anything wrong. I'm going to hold it, and then if the second best thing is I'm going to buy some more. But you've got to be committed, because the day will come where it'll drop a lot and you'll question, why did I do this, right? If you don't want to have all these risks and emotions, buy an annuity. We'll take care of you. We'll give you profits on the upside, no downside. Don't listen to it. Read the prospectus. We see horror shows and those things. Saw one recently where the guy put in a huge amount of money, and then he took his class after he did it, and now he's taking money out to sneak out the back door. But that one had a lot of penalties and all that, didn't it?
Yes.
What were the penalties? You remember?
I don't know what the penalty numbers were exactly, but it was something like you could get back maybe 10% of your investment if you took it out now.
10% of his investment. Can you believe that? I told horror stories about 1980 when they weren't that bad, and now we're seeing things like this. How is this possible? The insurance annuities are not securities, so the SEC, Securities Exchange Commission, doesn't get involved. But the insurance, how did they let this happen? I talked to another person recently, talked into buying some universal index life insurance policy, and she had to put in $2,000 a month, $24,000 a year, and at the end of 2 years, she had zero value. Pull it out, you get nothing. Oh my gosh. So do it yourself. Term insurance, buy the investments, you'll be fine. Minimum bond rating, on average, BBB, no big deal if you get down below that, but you're getting into some danger areas, buy a fund and let them do it. Average bond duration, 3.3, and then the average expense ratio on this portfolio is 0.19, because we probably had a couple managed funds in there. You could get your expense ratio, what's the lowest you've gotten it down on ETFs?
About 10.
0.10. And if you want to be really radical, you could probably get them slightly lower with somebody. If you go with Fidelity and set up a brokerage account, they have 3 different index funds. There's zero cost. I don't know if they'll give you a toaster or not, but you get those 3 funds. And then they expect you to stay with Fidelity. We're getting to the end, but you'll see in the book on page 175, and we'll update this now that Nash is going to be in charge of the allocations, but these are just some examples. Maybe no more than 3% in a single emerging market, no more than 5% in a high yield junk bond. We don't want to put all our money at risk. No more than 5% in a single sector specialty utilities, energy, technology, healthcare fund. No more than 10 in a single equity mutual fund like an S&P 500 or whatever that is. You could have several of the same thing, but not more than that in one fund. No more than 10 in international or global. Those don't go up as much, but they haven't been dropping quite as much. And then no more than 12 in a single balanced fund, and no more than 15 in a single investment grade. That's all in the book. And we're almost ready to go, but rebalancing you can do on a regular basis to try to get to the point where if something goes up too much, you get rebalance and bring things back to where it should be. And then I don't have time to put you all, these are recapping of all these things on page 178, and that's it. You made it 3 minutes late.
Can I ask you a quick question?
Yeah,
If
sure.
if you were trying to move stock funds, mutual funds, whatever they do,